Let's take a look at what we can expect in the medium-term budget policy statement set to be delivered in just over 40 minutes. It's crossed to SABC News senior economics reporter Nompumelelo Siziba. A very good afternoon to Nompumelelo. You're speaking to a range of experts about the challenges in the South African economy and what to expect from the medium-term budget policy statement.
That's right. Thank you very much, Nzinga. Well, of course, there are many stakeholders that are watching this midterm budget speech. One of those, of course, being the markets. And Nastasia will no doubt be giving us more detail about how the markets are reacting to these prospects of the midterm budget. But I'm joined by a market participant. His name is Reza Ismail. He's the head of bonds at Prescient Investment Management. And of course, he'll be very familiar with what markets are looking for from this midterm budget. Thank you very much, Reza, for joining us. So what are the markets expecting? We know that there's been a lot of sort of bad news coming through, that the finances are not looking sustainable. People are worried about issues like debt, the budget deficit. What are they looking at, and what's the significance of all this?
Yeah, I think so. The general context is that of a revenue line that is very likely to undershoot, and I'd venture almost to say that the revenue line is more indicative of almost a normalized revenue line. And I say this because if we think back to February or the 12 months leading up to the February sort of fiscal window, the main budget, then I think that revenue line was in some sense flattered by the fact that we had a massive surge in commodity prices leading up to that point, particularly sort of precious metals, and that has now abated and come off significantly. And I think this is almost like a more normalized revenue line that is indicative of a South African economy that is essentially void of any aggregate demand kind of pressures or activity, right? So you're going into the MTBPS with a revenue line that is likely to undershoot. All the attention will focus on the expenditures and how those are reprioritized. We do know that about a month after the main budget, that is in around March of this year, a public wage agreement was entered into, which will cover the next two fiscal windows. That was not in its entirety accounted for at the time of the February budget, so it will be interesting to see where that expenditure, in fact where the room for that is made from, and the hope is that in fact that does not come from be funded via cuts in sort of key critical service delivery areas and sort of key infrastructure spending. So it remains to be seen what happens on the expenditure side.
Yeah, and there's the tricky balancing act, as you say. But now we've heard from the finance minister in the last few days that perhaps he's got the option of not demanding so much of a cut in expenditure from government departments,
yes,
and will rather look to borrow more money from the markets. Now, we know that the government has already been borrowing much more than was anticipated. Can we really afford as South Africa for our public debt to rise that much more, especially if economic growth is not going to come to the party for the next couple of years?
Absolutely, yeah. So the short answer is no. We can't afford for the debt trajectory to basically become any steeper than what it already is. I mean, the idea is that we basically look towards that kind of debt to GDP trajectory to basically stabilize at least in the next 2 or 3 fiscal windows, right? So what that essentially would mean is that what we have seen communicated since around 2017 was National Treasury coming out to say that they would try and not let the heavy lifting in terms of the funding profile be borne solely from the nominal bond market. In other words, what we really don't want to see today is any kind of indication that the size of the weekly nominal bond auctions will increase, or that the main workhorse of funding this deficit will in fact come from the nominal bond market. And I say this because we know that essentially tap issuances at the back end of the yield curve have been a workhorse in the past, but with yield sitting at 13% at the back end of the yield curve, that does become a very, very punitive interest cost going forward, and that really can affect the kind of debt to GDP dynamics, and that can really affect the stabilization thereof. So we're really looking for the government, for Treasury rather, to sort of announce other levers with regards to its funding profile going forward, not only making extensive use of funding at the back end of the curve.
We're getting short of time, Reza, but I want to talk about something, but I'm hoping you don't get too technical. There's the issue that we keep on talking about debt servicing costs, which is really the South African government paying the interest on the debt that we have.
Correct.
We have a debt that's accrued to about 5 trillion rand, right?
Correct.
And then at the same time, there come points in time where the government has to pay the capital. That is the actual money that it borrowed.
Correct.
There are times that it has to pay that. What does that capital profile look like? How soon is the government going to have to pay those kinds of monies over and above, you know, the 350 billion rand a year or whatever it is that it has to pay on interest alone?
Yes, so I think those kind of calculations have been factored in by the National Treasury, and what they've been actually making use of is what's known as a sort of a switch auction. So they would look at sort of those near-term maturities that are going to come due in the next 2, 3, 4, 5 years, almost like the immediate near future. And what they've done is that they've said they've gone to those bondholders and they said that, look, you currently are holding a short-term debt instrument or whose face value we are likely going to have to pay in the near term. Could you swap out, or would you like to switch your holdings into a longer dated bond perhaps? And that has been done with a relative amount of success. So I think those kind of calculations have been factored in. What we are just looking for is no real material increase in the total sort of absolute size of issuance that is likely to come from the bond market in total.
Excellent. Reza, thank you so much for your time. That was Reza Ismail. He's the head of bonds at Prescient Investment Management. He says that the government has had to go to some of its lenders to say, look, you're holding some bonds for us and we would like to swap them out for longer term dated bonds so that we pay you later. But what happens if government approaches investors next year and wants to do the same arrangement and they refuse? What happens then and they don't have enough money to pay? That will be a very dodgy situation indeed.